Hi guys and welcome back to Yashi. This time we have more of a housing update. Normally I specifically talk about housing when I do these updates here, but since it kind of goes all well into financial markets, inflation and everything, we gotta do a little bit of everything just to understand what is happening in the economy. So let's get started. Of course, housing is very dependent on mortgage rates. So let's start with that. Mortgage rates today, we have 7.20% on a 30-year mortgage, 6.43 on a 15-year mortgage, 6.67 10-year, and 5.55 on the ARM mortgage. So interest rates were pretty much stable compared to last week. They didn't move too much. However, the discrepancy between 30-year and 50-year actually became smaller. Last week it was much better to do a 15-year if you calculated the stuff, considering that you would pay it off much quicker and you would pay much smaller of an interest rate. It was almost around 6 or even 5.9 if I remember correctly. Anyway, the 30-year is pretty much stable. We're gonna see what happens with mortgages. I believe, not financial advice, if the Fed hikes by the expectation of the markets, mortgage rates will stay either the same or even drop, like it happened last time where the Fed kind of matched what the market was expecting. Why is it that? Because the market likes security. They like to see that their thoughts are confirmed. I will go into that deeper into another video. Number two, what is happening to the stock market? Dow Jones falls ahead of Fed meeting, 6 top stocks to buy and watch. People have the expectations. We had a small drop, nothing too specific. I don't want to go too deep into stocks in general, but we know that something is dropping. Now on to housing crash. This is an interesting article. Is the US headed towards a housing crash? Experts say it's not 2008. We're starting to see articles again, as we were seeing in the beginning of the year towards March, where the Fed started to raise rates. Everybody was expecting huge crashes, and the media initially said, yes, stuff will slow down, but it's not like 2008. And they're starting to bring back these articles after, how can I explain it? In the beginning it was like this, then it got very negative as interest rates went up by a whole lot. It wasn't expected to go up that much, and many news outlets started being much more negative. There's a housing coming, prices are dropping, sales are down. But now, prices didn't drop too much, and I'm starting to see news outlets bringing up the same arguments that were bringing up in the beginning, meaning the housing market is not like 2008 because mortgages are much safer than they were. There's much less houses for sale, while in 2008 there was a surplus of homes for sale and people were just exchanging them, kind of like a pyramid scheme until everything crashed. And supply, it will not go up. And later on I will show you some data that actually confirms it even more and confirms the theory I gave out in the past couple of days. Inflation news. Eurozone inflation hits record high at 10% because Europe is not reacting as fast as the US is, which means that the US dollar will become even more powerful. We're kind of building the perfect setup to just import a whole bunch of inventory for much cheaper. We're getting discounts on everything. If you're an international person like I am, I'm looking at houses in Italy right now because I'm getting a 10-20% discount because I'm buying in US dollar, but that's just me, not financial advice. Gas prices have been pretty stable. They've been dropping in the past 2 weeks, but today they increased on average, national average, by 1%. We're expected to see a lot of gas increases in the next couple of weeks as we have some states that are coming back, they're, let's say, taking out the tax holiday they implemented during summer. Florida is one of them. I believe, Virginia, Richmond, Los Angeles, no. From now only so Florida, which will increase prices by 25 cents as the tax holiday ends. So let's see how that will offset the states that are reinstating the taxes, how that will affect the averages. Now on to food prices. Now I'm looking at the only two things that are not considered in the CPI report that the Fed looks at, because they look at core inflation that does not include energy and food prices, but I'm still looking at them because they affect the prices and the cost of living of everyday Americans. I saw this pretty interesting article saying that with data, I will not dig too deep into it, agricultural prices aren't driving food price inflation. Most of the inflation is a consequence of transportation, packaging, and all the rest that comes around. So it's basically stating this and saying that over the long term, food prices will mostly follow core inflation based on multiple graphs. I don't want to go too deep into it because it's very complex, but the data makes sense. If you want to look it up, I will add this link onto the description of this video below. Now onto Redfin news. This is interesting because last week I showed you, I pulled the data from Zillow and I showed you reports showing that supply is not increasing at the pace that people were expecting. Supply is starting to decrease again, and supply might offset the decrease in demand, which will either stabilize the prices where they are now or even increase them if it keeps on dropping as quickly as it's starting to drop now. Look at this. Now I'm looking at active listings. These are the homes that are for sale. This was from March all the way to August. We saw a steep increase in supply because home sellers were trying to push their homes on the market before interest rates would go too high for buyers to buy, and demand was starting to go down. So that increased the amount of time that homes would spend on the market, and so also increase the amount of supply, because the more homes stay on the market and the more homes get onto supply, the higher the supply, as you've given a demand that does not really move. Now the demand is even going down, this will increase the space even more, and that's what we saw until now. But now we got to a point where if you own a house and you want to upgrade, you won't upgrade because you're upgrading on, even if it's the same size house, your interest rate will be double what you got in a year ago, so there's no incentive. Builders are not building because they're scared. So I believe that most of the homes you're gonna see for sale now is mostly investors trying to get some cash flow or buy something else or accumulate some money because they're scared, even though I believe they shouldn't be because rents are high and it cash flows very well. But it's my perspective, not financial advice. So I believe that most of the homes for sale are either people that own multiple homes or investors. And we got to a point now where that trend is starting to go down. Listings, active listings are dropping, and if we look at month of supply, year over year 3.8. No, this data is incorrect, I believe, unless we look at everybody. Weeks of supply, okay, weeks of supply. I thought this was months, that didn't make sense. Weeks of supply is higher than 2020 and 2021. It is actually increasing, which doesn't make sense. Okay, now it makes sense because demand is dropping on paper. List of sale, median sale, age of inventory. Let's see, age of inventory. 59 days in 2021. The age of inventory is still lower than the end of 2021, which basically means given interest rates that are doubled in 2021, giving home supply that is increasing, the age of the inventory is still lower than the end of 2021. There's still a lot of demand, guys, compared to the supply. And again, as supply will start going down, I don't have the data of new listings, unfortunately. I cannot see. Yeah, I can see new listings right here. New listings, right? Okay, perfect. Year of the year. This is exactly what I was talking about. So we saw the trend of increasing supply of homes for the past couple of months, and then it started going down. And it matches what I see here, because on top of having still high demand, you now have people that are not putting their homes for sale anymore. So new listings coming out to the market is dropping. And year over year, we're minus 21%. There's minus 21%. So there's 21% homes put for sale this month less compared to a year ago. Guys, supply is not going up anytime soon, in my opinion. And yes, home prices may have reacted, but as you can see also here, this is Los Angeles. Let me do national. Okay, it has been going down, But if you look at single markets, you start seeing it starting to plateau again. We'll see what happens. In my opinion, that as soon as the Fed pivots, given the conditions we have now, I believe that the market is set up for another enormous bull run. So the Fed has to be careful about pivoting because there's still a lot of demand, which means that if they pivot and the conditions get better for buyers, you will have an enormous amount of buyers flowing in with this supply that is so low. I believe that a pivot in the Fed should not be a decrease in the interest rates. It should simply be a stabilization of the interest rate until supply is being pushed up again. Because if there is a pivot and interest rates and mortgages become cheaper, the inflow of buyers would create another 2020 and 2021 condition again, where home prices see increases in double digits again. So we'll see. This is just my opinion, not financial advice. Let me know what your opinion on this is. Last but not least, in terms of inflation, we know that inflation is driven a lot by transportation costs, which is part of the core inflation that the Fed looks at, although transportation is also being affected a lot by gas prices. Anyway, you remember a year ago when Los Angeles ports were full of ships? Well, that problem is not there anymore. I looked at this article here that looks specifically at the company, but it takes some general macro data that you can check. Let me see, where are you? Right here. Daily backup of container ship waiting at the ports of Los Angeles. This is the beginning of the year, end of 2021. Look at how much it dropped. Truckload spot rates are down 37% from the January 2022 highs. So we're getting close to that 1 year, year-over-year mark, and we will see a decrease. Let's say, once we get to January 2023, it will result that prices actually dropped compared to January 2022. We're getting close to that mark. On top of that, I released an update a few days ago that also stated that container costs dropped from 9,500 all the way to 2,500. So, and again, if you go back onto the agricultural data, it says that one of the biggest effects on the cost of food was everything that went around food, not the food itself. One of which is transportation. So yes, although food is becoming more expensive, especially now that Russia cut the Ukraine corn, wheat, wet, I don't know, you say wet deal. Funny. Yes, it affected the prices of food, but the prices of food are mostly, according to this article, affected by transportation, packaging, and everything. This was confusing, I apologize for that. Anyway guys, thank you for watching, that's all for now, nice and quick. Please let me know if you have any questions, if you would like me to talk about other specific factors in the economy. Thank you for watching,